In this presentation, we will take a look at the adjusting entry related to payroll for our simple bookkeeping method. Remember that the adjusting entries are something that we would expect the tax preparer or the accountant to do at the end of the year for the adjusting entry process, but it's a good idea to understand the adjusting entry process, and we can do some of the adjusting entries if we so choose. We're going to do it in a worksheet so we can see what actually happens, and then we'll take a look at entering that into the QuickBooks system as well. For more accounting information and accounting courses, visit our website at accountinginstruction.info. We're going to open up an Excel worksheet for the adjusting entry process for our more simple bookkeeping system that we created from QuickBooks, and we'll open up the QuickBooks file for the more simple QuickBooks process. So we're going to go into the QuickBooks data files. We're going to open up the QuickBooks 1 file and open up that QuickBooks file. There should be a backup getting you to this point if you so choose to use that as well to get to the same point in terms of data. We're also going to work and open the adjusting entry worksheet that we set up in Excel. And this will give us a more visual of the actual process that would happen in this adjustment. So we're going to go to the documents. We're going to go to 2019. And then we have this employee wages document, and then the adjusting worksheet that we're going to be working with. This is the adjusting entry that we can enter this data into that we created from Excel, just a mock adjusting entry worksheet. And this is going to be data that would mock some of the information that we could get from a payroll company in order to make these adjustments. Our goal here is to say, hey, we didn't do the payroll for this system. We're going to get the payroll information from the payroll company that we're teaming up with, either give it directly to the client or the payroll company talk to us, and then we'll provide that to the tax preparer at the end of the year to make any types of adjustments related to payroll. So I'm going to open these two up and we'll take a look at this information. Here is our trial balance. Now all I've done is added some color to the trial balance, make it look a little colorful here. And so we have our assets, our liabilities, equity, income, and expense. We can even see net income down here by seeing the sum of the revenue minus the expenses. And that's currently showing a loss right now. So what we're going to do is just make some adjustments and say, okay, what we're focusing in on is the payroll account here, that we've just been entering the net checks and any payroll liabilities that come through as just everything to payroll expense. Now there could be differences in terms of timing differences, and we're not recording any kind of liability as we go, which would normally be the process. Now it should wash out in terms of a timing difference and be okay, but that we might have a difference at the end of the year due to a timing difference. And one way that the tax preparer might be able to make an adjustment is to look at any W-2 information from the tax preparer or the payroll preparer and tie out our information to it. And so this will just be kind of a simplified idea of what that might look like. So we know we give a W-2 at the end of the year to our employees. This is a summary worksheet actually printed from Excel, from the payroll in Excel, giving us the W-3, which is just a summary of all W-2s. If you put all W-2s together, then you could say this is one employee, like we had one employee that was a W-3, which is basically the sum of all the W-2 forms that would be given out. And we had the compensation here. So this was the actual compensation. This is gross compensation, not net of the taxes. And then we took from them federal Social Security and Medicare taxes. So this is the amount of withholding we had. Now note there's also the employer portion of the withholdings, which I'm going to think of just now as just the Social Security and Medicare. So this is kind of a simplified way to think of it. But this full amount here is really what was paid to the employee in gross. And then we took some money from them, but we paid their taxes for them with it. And then we paid on top of that the taxes for our employer portion, that's what's really called payroll taxes. So really, we should be matching the wages. And if we had any kind of other deductions like a 401k plan or retirement plan, then we'd have to make sure that we'd have to adjust the correct wages that we had there. But we had none of that information here. So this then is the gross wages that we had for this time period for these two employees. And that should really match what is on our expenses. So if the IRS really wanted to tie that out, this is one way they might do that. And so we should say, okay, just to make sure we don't have any problems with the IRS, we're gonna say that our wages expense should basically match what's on the W-2. Now remember, again, there's 3 wages on the W-2. So if there's any other things that were taken out of the W-2, like the 401k plan or something like that, you got to make sure that you're picking up the correct wages. But here we have this number here. So we're going to tie that out and say, okay, on our form, we've got this number, 8,833. So I need to make this number be this number. So what are we going to do? Subtraction problem there. I'm going to say this expense then needs to go up. So I'm going to copy it. I'm going to make a journal entry over here. I'm going to paste it 1, 2, 3, just the value, so we can just type it in here into our journal entry. And I'm just going to say it's going to be this 10,766. So I'm going to say this equals 10,766 minus what we have, 8,338. So there's a difference of 2,428 in there. Now, the other thing that we have here is the employer taxes, which if we look at our form here, one way to calculate it, or some employer taxes, will be that we have to match the Social Security and Medicare. So in other words, this Social Security and Medicare was taken out of the employee wages, but we also paid another $614 and $154 ourselves as the employer portion. So there could be other employer taxes like federal unemployment insurance and whatnot, and other taxes that we might be responsible for, but at the minimum, we have these two. So really on the tax return, we kind of should break that out. There's typically another line item for payroll taxes. We shouldn't put it all in the payroll expense because it won't tie out as easily. If we want to make everything tie out nicely, so if the IRS had any questions, they can basically just take and tie those two out, then we should break that out. So it doesn't always happen, but we should say 614 plus 154, so there's 768 was employer taxes. So I'm going to go back over here and say the payroll taxes, this is what we paid to the employees, and on top of that we had payroll taxes, not the employee taxes, but the employer taxes. Going to copy that, and that's an expense for the time period of 768. And then if I add these up, it adds up to 3,196. I'm going to do that with a negative sum. This is the credit, it needs to be in balance. And that I'm going to assume is basically a payroll liability. That's something that we still owe as of the end of the year. So I'm going to put that up in the liability section and say right-click copy and paste that here. And if we post this, then I can see what this adjustment will do and see if it does kind of what I would think it should do. So we're going to go to the payroll expense here in the middle column. And I'm just going to say this equals our adjustment here. And that goes to 10,766. And that's what we would think, because that's kind of like what we think on the W-3 that payroll should be on these forms that we're reporting for payroll taxes. And then the next one is going to go into the payroll expense. This equals the payroll tax expense. And that's what we think it should be based on our calculation. And then the liability here should equal this amount here. And so we're still in balance. Debits still equal the credits. We're still in balance. And we lowered net income by adding the payroll taxes basically here and having whatever timing difference that is going to be there. We're not totally sure about this number based on the information we have. All we did was make these two numbers right and assume the difference is what we had not yet paid. Now we can check that in the system and see, did we pay that in the future? We can see when payroll actually got paid and kind of see if this liability looks right as of the end of the year. But this is just an example of the kind of adjusting entry we would do. Now we might have a bookkeeping system where they actually do that adjustment in the bookkeeping system. So if we were to do that, if we go into QuickBooks and we just enter this into QuickBooks, we could say, okay, let's make a trial balance in QuickBooks. Here's QuickBooks Home tab. This is open with the view and the open windows list. Reports drop down. I'm going to go to accounting and taxes and look at the trial balance here and say this is going to be as of 01/01/19 to 12/31/19. So there's our trial balance. And this is just like our beginning trial balance. I don't see the adjustment column. I can't see that, but I could just enter our journal entry. And then the journal entry would just be going to the same thing. We'd go to the company and make journal entry. And then we're just going to enter the same journal entry as of the end of the year, which will be 12/31/19, the date we're making our financials. And we would just do the same thing. So we're going to say payroll tax expense. So I'm going to say payroll tax expense. We need a debit of 2428. So that's 2428. This is adjusting entry for payroll for the memo. And then we're going to say that there's a payroll tax expense, which we don't have. So I didn't set that up here. So I don't think there is a payroll tax expense. So we'll start payroll tax expense. I'm going to make this account. And QuickBooks doesn't make a payroll tax expense to kind of simplify it. But again, on the tax return, there is a line item for the two. And if we want to tie it out, just to avoid problems in the case that there's questions about it, we could say, hey, these two things match exactly, our payroll forms and our information on the tax return. So we'll make this an expense, payroll tax expense. And it's trying to say what we need, but that's not what we want. We want this to be a debit of $768. And I'm just going to copy this. That's an adjusting entry. And then we need the payroll liability and see if they gave us that one. There's payroll liability, and that's for the 3169. 3169, that looks right. So that's our adjustment. And if we save and close that in QuickBooks, it'll basically do the same thing. So you'll note that QuickBooks, we've been avoiding kind of debits and credits the whole time. We don't really need them because QuickBooks will let us enter the data without them. But with these adjusting entries, we typically would have them, and that'll give us that same adjustment. We can't see the detail as easily here, but here's the payroll liability that we can look at. And if we double click on it, we'll see our adjusting entry that we made. And so we'll be able to adjust this. And again, we probably would have the accountant do this. They might do this in their copy of the QuickBooks file, and then maybe provide us with the changes they made, and we could decide if we want to put it in our file, our QuickBooks file, or not. Remember that these changes on the income statement down here are just going to wash out into equity anyway. So if our major purpose is the creation of the income statement for tax preparation, it may not be necessary for us to take their transactions and enter it into our system, because it could get messy. It could make things happen that we don't quite, we didn't want to happen. So we might just say, hey, we're just going to keep on entering the data this way, make the income statement correct, be able to reconcile the bank accounts, and then you can make this adjusting entry at the end of the time period. Or we can enter these adjustments, which could make the balance sheet a bit more accurate during that time period as well. So there's a couple different options here. These are the two methods that we might see the adjusting entries done for the payroll when doing tax preparation or at the end of the year. It could be done in QuickBooks, could be done outside of QuickBooks in some type of worksheet such as Excel, or even just on paper and pencil as we enter the information into the tax software. For more accounting information and accounting courses, visit our website at accountinginstruction.info.